Good afternoon, Singapore. This is Michael Elko, Head of Hong Kong Strategy Development for Bloomberg. And thank you for joining us today on this interesting panel here on ETFs and indices, part of the 2022 APAC Blockchain Forum.
William Fong. I'm the treasurer and I look after also the OTC trading at Zerocap. We're a Melbourne-based cryptocurrency investment bank and asset manager. You probably know us from recent headlines where we're partnering ANZ Bank in Australia to create the first ecosystem for Australian dollar bank-based digital currency. We created this addition to our initial ecosystem where we employ a usage for this particular $8DC, and that generated a tokenization chain down the track where we used $8DC to convert into a US dollar DC as well as purchase. And we purchased a tokenized carbon credit, which is originated within the Australian platform. So everything was kind of constrained within the Australian platform where we use localized firms. We originated from, obviously, ANZ, you understand, is a Melbourne-based global bank. We, as a Melbourne-based global investment bank, and then we partner with Beta Carbon, which is also a Melbourne-based carbon credit tokenization firm. And we help the largest family office in Australia, the Victor Morgan Group, to enter into this particular space, generating a huge publicity, as you understand, from our recent publication with the AFR, Bloomberg, and other top media resources. I think it's interesting to see the linkage between even ETF and asset management. 6 months after the world of asset management institutions took notice of cryptocurrency as an alternative diversification of their portfolio, when we had the first ever futures ETF being listed in the US, well, we saw peak pricing in cryptocurrencies. Now, it's a funny thing because last Tuesday, when Bitcoin fell below $20,000, we actually saw the first listing of short Bitcoin futures ETF being listed in exactly the same exchange in the US by the same people who constructed that first long BTC futures exchange. So could we actually see a bottom of that particular issue? But does that mean that people will actually lose interest for this particular portfolio diversification into the crypto space? I personally think not. The point is, from my last count, there's about 50 to 70 trillion US dollars worth equity investment in asset management. There's over 100 trillion US dollars in fixed income investment. The last count, the entire market cap of cryptocurrency was less than 1 trillion. So how can we ever become the whole of time constraint for any type of real world asset manager to look into this space and spend all their time on this particular diversification? Right, you only have to allocate 1% of the other space and you purchase the entire market share. That doesn't work, right? But what do? They can't really allocate 0.01% of the portfolio into this space, because even if it goes up by 100%, it wouldn't really matter. So I think there's somewhere in between that. And somewhere in between is where the expertise comes in. And it's with the expertise of how Zerocap and other type investment banks in this space who can provide a bridge between the traditional finance, institutional asset management, and the technicals and the particular market knowledge and intelligence relating to this part of the fence. And how we could actually integrate this knowledge and provide a solution which the other side of the fence could say, okay, I'm comfortable of allocating 5% of my portfolio into here because you provide the credibility and the language I understand, as well as you have the upfront of the frontier of innovation, which I lack. I think that integration, it's what it will actually keep the money inside cryptocurrency as asset class. and how we could actually move forward and grow this particular industry into something that's credible, something that's scalable, and something that will actually take advantage of the knowledge that we're actually trying to generate. This is an interesting question, because if you asked me that a month ago, probably I wouldn't have the same answer for you. But I think nowadays, what we saw since the last November drawdown 6 months ago is that for most retail investors nowadays, market risk is no longer a concern. Most of the tokens drop by 90%, 95%. So if you're willing to put your money into this particular investment, market risk is no longer a concern. You're basically looking for a 10x on the other side if you're willing to do your homework and put money into the specific tokens that you're looking to put through. But I think the credit risk is definitely not a concern. What we saw in the headline in the last few weeks is literally you can put your money in there and there's a lot of guarantees of 20%, 30% yield enhancements. There's a lot of return of 10x, 100x guarantees. But the point is, you're not getting your notional back. There's gates, there's withdrawal pauses, there's unknowns. You don't actually know who they're lending your money to. You have no access to private keys. And everything's mingled together as a pool of funds that you have no idea where you actually went by the time you try to knock on the door and ask you for your money back. Forget about the interest you're getting, because you're not getting your notional back for a very long time. So I think credit risk is the major concern. Now, to differentiate between the institutional and wholesale side and the retail side, it's where the clearinghouse, the exchanges, will come in to protect against the retail sector. And that's where Australia has done on the point that we've looked at this, retail needs to be protected by sophisticated clearinghouse settlement procedures through the exchange traded funds. Now, the accredited, more professional, institutional type investors have done their homework, knows who they're actually dealing with, and have done the due diligence for the counterparty risk. Then they could migrate away from the exchange platforms into the more what you call OTCs, direct investments, asset management, or institutional wholesale investment platforms through investing in Zerocap, for example. So I think that the two differentiation allows the regulators to sleep sound at night, knowing that the retail sector is not going to be blindly putting money into institutional type of binding that they have no idea where the money is going, and they have no idea how to do the due diligence for their end money. I think we've got different type of products and research we've done on different type of indexes constructions. I mean, obviously the top 10, top 20 matters to majority of the people. They want to know about the top 10, top 20, maybe like what James said, taking out stable coins, maybe wrap Bitcoins and some of the more interrelated type of linkage. But then there are others who wish to know about new protocols. They want to know about how the DeFi space works. They want to know about which coins are actually up and coming, which are the potentials for investments, for example. So here in Zerocap, we're actually looking at various types of usage of new protocols to come up. I mean, obviously you've got Bitcoin and maybe Paxos as the valuation or the value of holding as in the cryptocurrency world. And then you got Ethereum, which is basically the medium of exchange, the usage, the highway to go and use cryptocurrency for efficiency transfers. But then you've got others as well, which is trying to solve a solution. And so we're actually looking at multiple type of index constructions that we've actually launched, and we are talking to our clients and just constantly asking for their needs. Recently, we actually launched a Zerocap Innovation Index, which we construct 20 up-and-coming protocols. 10 of them we allow them to remain dormant, and those we actually constantly are monitoring them and studying them. but 10 of them, we put them into portfolios as active type of protocols where we're monitoring their indexes and constructing investment opportunities with them. But every quarter, our investment committee actually monitors them and perhaps even do rebalancing between the 20 protocols and tokens. And some of them, if they fall out of range, perhaps we might even throw them out and put something else back in instead. And obviously, we do documentation of the full reasoning why this portfolio is constructed and which ones should go into dormant and which one we should take out of dormant and put in the active. So I guess we're probably just moving slightly down the track from the top 10, top 20. And just for maybe the more tech savvy, the more innovative investor who comes to knock on the door and say, I want something different. It's kind of interesting because we saw a different migration of investors and investor interest on the product that they specifically targeting, right? Obviously, when everything's going up, you kind of close your eyes and just go and buy. And they just simply buy the ones with the highest, or the lowest liquidity, the highest daily gain. But then when volatility started to pick up and drawdowns started to happen, we saw a lot more people migrating towards perhaps even volatility enhancement, right? In a way that the risk element shifting from so much of day trading into buy and hold, into perhaps put cost sell in order to capture short-term volatility, or the structured products, in a way that you can see that a slight migration from the perspective of the investor, slowly moving into different realms in order to capture how the market is actually migrated. And now we're looking at people who are saying that, oh, okay, well, maybe I don't mind buying Bitcoin at 15,000 or even below 20,000. Well, if you are able to allow me to capture the full market volatility to enter into a node where I could actually pick up a Bitcoin at 17,000, but if it doesn't go to my target, I actually get an yield enhancement node and get paid for it, then that might be actually a good solution for me, right? And once we actually push that up a bit more, then people will start to say, oh, maybe we've hit the bottom. There's a solid ground below us. News headlines start to come out and bullish things start to come to media. Regulations start to pick up in a sense that's bullish for some of the protocols. Then you have people coming out and trying to create the FOMO effect once again. And they say that, well, look, just don't worry about picking the bottom. Let's go and buy some for me. Let's get on there, right? Let's construct a portfolio. Let's do it today, right? Let's do it yesterday. So I think there's always investors who's looking to allocate to this space. I think since Q4 last year, I believe a lot of institutional, especially even pension funds, even more of the mutual funds and more conservative family offices have gone through the process due diligence into this space. They've gone through the investment committees. They've got the tick in the boxes. And they say that, okay, you can allocate anywhere between 2 to 5% of portfolio into cryptocurrency. But they've held off because there's been, we've hit $69,000 in Bitcoin and we haven't seen that since then, right? We've had all these regulations come out. We've had ETFs that came on trading below NAV. We've had non-ETFs trading below NAV, the one that you mentioned previously. And so there's been a lot of holdback, right? There's a lot that has come out and they started to enter into the space, but they found that they basically putting their hand out and the sword just went through it. And they kind of burned themselves a bit. But I think that as the market stabilizes a bit more around these areas, we are seeing a lot of, you couldn't even say bottom fishing, but portfolio allocation. So if they had a mandate for 5%, we're seeing that 1 to 2% is starting to come back in. And they say that, okay, well, let's do this. Let's start to allocate some money into this space and let's play for the long term. So I think that that's how the investment mind has been. I don't think we've got the FOMO effect anymore because volatility, even though daily volatility is pretty strong, but the absolute volatility for the last month or so has been fairly stable. I mean, we have one clip down on event risk, right? You have Lunar Terror come out, then you have a week of scarcity. Basically, everyone went for the fence, and then it stabilizes a bit. Everyone comes back and start buying things. And then you have another entity saying, oh, we can't allow you withdraw anymore. And then things kind of close down a bit. Everyone's trying to get their monies back. But I think that there's definitely a credit risk issue. For those who are having a trusted partners, or for those who's put their money in time and put in cold storage, they are definitely starting to come back and they want to get back into the investment phase of their cycle. And that's what we're seeing. I think what we heard from the panel previously upstairs was that over 90% of current cryptocurrency trading is involved with retail sector, right? The institutional side is really negligible. It hasn't really been touched, and I don't think any of the main big blue chip institutions have really drastically put their foot into this space. So some might tiptoe and some have done this. What we've been trying to do is really trying to start something new, start something that's on a niche. We've been moving towards the blue chip migration, right? We've partnered with ANZ, we've partnered with some of the big names like Bloomberg, and we're trying to make things more, I guess you can say even expanding the space cryptocurrency. Because our latest ventures, it's really about ESG as well. We went into tokenization of carbon credits, right? I mean, if you just look at ESG, green, carbon credits, tokenization, you might even never thought about cryptocurrency at all, right? None of them even sound like cryptocurrency. It's nothing to do with the NFT, metaverse, or any of the Bitcoin, Ethereum. It is on the ERC-20 blockchain, obviously, but the point is we're trying to bridge between the TradFi world and every type of asset class and making the use of efficiency of the blockchain to matter to everybody. And that's how I personally feel the future will be, is that the advantage of the blockchain can improve TradFi asset class. The entire $200 trillion of fixed income plus equity plus property assets, anything that could be securitized and tokenized can be put on the blockchain, can be tokenized, so it can be made into ETF. It can be invested by the retail sector without the vulnerability of credit issues, lockdowns, and withdrawal issues, because the blockchain is transparent. They can see where the record is. They've got full private keys, custodian services. They could have the full clearinghouse protections. So when we slowly migrate towards that space, then maybe in 5 to 10 years' time, well, I don't know, this space moves very fast. Maybe within 2 years' time we'll get there. Then you probably have half of the ISIN registered fixed income issuance coming out of Bloomberg that's going to be tokenized, right? There's no more T+5 Euro clear waiting for settlement thingy. You're basically going instantly, here's my money. USDC's gone straight in, $8 gone straight in. You've basically credited straight away with your ANZ bond. So I guess that's how I see a future, is basically the efficiency and the benefit of the blockchain to virtually migrate towards the traditional finance and making portfolio management so much more easier and so much more practical. I mean, we're kind of saying that from the day of when you buy a bond, you physically, a guy have to get the paper and run 10 Street to deliver the bond to you. We've gone a few steps past that now. It's T+3 to T+5. Imagine you do that within 2 seconds.
Yeah, one of your panelists in the other room right now from PwC actually told me one time, I've been consulting with finance companies for 30 years, and the greatest achievement is we moved from 5 days to 3-day settlement. And so, so why he believes in blockchain is that the acceleration of that can be so much faster.